Hello, everyone. Thanks for tuning in to another edition of When Andrew Met, and again, another edition of the Search for Income mini-series. And today I'm absolutely delighted to be able to have Dan Hanbury here in front of me. Now, Dan, to the investment world, is a very famous person. He's one of the founding partners of Dividend Mercantile, and he joined back in 2006. And he's been managing UK equities for 20 plus years. He's a lead manager on the Dividend Mercantile UK Smaller Companies Fund, but for today, and more importantly, the lead manager of the UK Equity Income Fund. So Dan, thanks very much for popping in today, virtually,
Pleasure.
Obviously, because that'd be a bit weird, because why would have someone have a house that looks like this on one side and that on the other side? So it's virtually, everyone, if you hadn't guessed. So first off, income investing, I feel is probably the most difficult discipline at this moment in time. Obviously, dividends have been slashed across the market. When do you think we'll go back to pre-pandemic levels?
Well, first of all, thank you very much for having me on, Andrew. It's a pleasure to join you today. Yeah, you're right. I mean, if you look at the contrarian nature of the opportunity now, it's quite extraordinary. The overall UK equity market is extremely unloved, very depressed valuations versus mega equity market. Within the UK equity market, you can have this big dichotomy between sort of growth stocks and income stocks or value stocks. So a lot of the income managers who've been running income funds have had a really tough time over the last few years trying to beat a benchmark that was really being driven by those big growth stocks. You've had a number of income managers and value managers leaving their positions, and of course, there was some high profile losses from the sector last year. So that's really opened up quite an interesting opportunity in the sense, because the pandemic on top of that has seen huge slashing of these dividends that did in fact look quite unsustainable. That the yield on the UK market did look artificially high, and we knew that yield cover, if you like, dividend yield cover was low, and that was why income managers like myself used to go into smaller companies, go to international stocks to diversify our income, so that we weren't maybe overly exposed to some of those potential dividend cuts. The pandemic has really been the catalyst then for that big reset. And we've seen dividends down. We're going to see dividends down 30 to 40% this year across the market. And of course, it's not all because they've been forced to for financial reasons. It's for political reasons as well, where companies, particularly the financial sectors, where they've taken maybe furlough money, they don't want to be seen paying income. And there's been this big reset. Nonetheless, because the UK market is still very cheap, very unloved because of Brexit, because of the nature of the market, we've got quite a lot of cyclical sectors as well as those big defensive sectors. There is now an opportunity because the yield is still pretty reasonable, actually. You're still getting a 4% yield, whereas it may have been 5.5%, 6% before. Yeah. It's sort of 4% yield. And that's a great starting point. And actually what we're starting to see now is a lot of the good companies in the portfolio who temporarily cut their dividends have already started bringing dividends back. So if I give you a couple of examples, Direct Line Insurance would be a holding, Mondi, the packaging company. These were both companies that completely cut their dividend in the first wave of the pandemic and have already reinstated that dividend in full, and it's starting to come back. So, but in terms of, just to your question, when do we think we're going to see a recovery in those dividends? I think there is going to be a downshift in payout ratios on average, because I think management are going to be thinking in terms of we need sustainable dividend growth, and maybe some of these high yields were unsustainable. There's clearly some structural challenges in certain sectors like the oils, BP and Royal Dutch. We're not going to see those dividends come back in a big way soon. So we look at it in aggregate, and we started modeling right from kind of April time. We were looking out to 2024 as a sensible path to be planning in terms of the recovery in dividend income within our UK market back to 2019 levels. Now, actually, I'm slightly more encouraged than that in recent months. I've seen indications that might be a bit pessimistic. Actually, maybe things will come back a little bit soon, and we may see a decent recovery in 2021 that drives that a bit quicker. But certainly that's how I'm planning when I look at the overall portfolio. Is yes, we'll see some strong dividend growth here from here. And if you think about it from a contrarian opportunity, you've got your risk assets, you've clearly got your sort of safer assets that we all like to hold as well. But within your risk asset basket right now, I actually think an active UK equity multi-cap income fund, where you've got the alpha generation possibility of smaller companies, and UK equity managers have generally done reasonably well, actually, active managers, whereas around the world it's been more difficult because of the likes of Amazon driving the market higher. And you've had that slashed income. People have lost faith with the income sector because of poor Neil Woodford and what happened to him, if you like. And so I look at it as quite a great base to start from. This is a great contrarian opportunity, a nimble multi-cap income fund in a very cheap, unloved market. We're about to get through Brexit one way or another. US election obviously happening today. There will be improvements in the outlook on the pandemic, and so whether it's therapeutics, a vaccine, or just better contact tracing and the transmission falling. So there's lots of things that are now starting to look quite interesting, I think, in terms of catalysts for an improvement in UK income stocks.
That's really good. Looking at specific sectors or possibly even companies, is there anything there that's exciting you at this moment in time?
Yeah, there's always, the wonderful thing about the UK stock market is it's very deep and international market. As you know, 75% of the profits come from overseas. If you look at FTSE, even down at the small cap and mid cap end, where we're spending a lot of time looking, as you rightly pointed out, I run the smaller companies fund at River Mercantile as well as the income fund. And even there, 45 to 50% of the earnings are from overseas. So it's a very international market. There's constantly a reinvigoration of that market with new companies IPOing and coming onto the market. So you've got this huge choice. And we often find these wonderful kind of global market leaders lower down the market cap scale, which provide real opportunity. So we think there is some really interesting stocks and sectors at the moment. We're not thematic investors; we're very much bottom up. But if I was to point out some clusters of stocks, if you like, where we're seeing some real interesting opportunities, I think it's the last year, and we think will continue to help us in our portfolios going forward. The most obvious one is gold. Gold and gold stocks. As you know, the gold price has moved up over the last couple of years. We think everything is in place for gold to continue to do well over the next few years in the medium to long term. And actually, a lot of the stocks still aren't really reflecting that higher gold price yet. There's still a lot of modeling of the gold price still coming down. And a lot of the multiples on those stocks remain pretty low, actually. So they're quite cheap. So we're retaining that insurance policy in our portfolio, which is a number of gold stocks, typically anything from 5 to 10%. We're about 6% at the moment. So that's one theme. We're looking at themes like defense. We actually think defense spending will continue to be robust. Still very low levels versus GDP being spent by governments at the moment, particularly in Europe. And unfortunately, crises like the pandemic and some of the kind of more populist movements at the moment, they often lead to kind of tensions and crises in the future, unfortunately. So we think defense spending is going to remain very underpinned, and you get good order books, good earnings visibility. So we own defense stocks. There's classic market leading consumer stocks like Unilever, which play a role in our portfolios, which always look attractive versus bonds in terms of protecting your wealth and tracking global nominal GDP going forward and protecting the purchasing power of your wealth. Having an allocation to companies like Unilever is a really sensible thing to have. There's the survivors after you get a crisis. So you've just had this big downturn in consumer discretionary stocks and obviously financials with the pandemic. And again, what we would do is hunt for kind of market leaders in that situation where we think they're going to be the survivors to come out and win at the other end. So for example, we bought both Halfords and DFS Furniture, both market leaders who we felt were going to be in a strong position to ride out the pandemic. If you even go as look at something like an airline, like an EasyJet, EasyJet are probably going to be one of the low cost carriers that come out one of the winners at the end of this. And I think, people will get back to traveling at some point. There's going to be a loss. Don't get me wrong. There's going to be lost travel from business travel. There's going to be a certain older sort of traveler who may not travel as much. But so we're looking for those kind of, let's call it really strong market position companies that have been hit very hard by something like a downturn, an economic downturn or pandemic. And then we're looking to buy those in the recovery. Specialist financial companies like insurance companies, lots of really strong solvency positions, great dividends coming out of the insurance sector at the moment. Non-life insurance is a good place for us. And then technology and media, again, we all see these staggering valuations and what's going on in the US at the moment, and the size of these companies, Amazon and Microsoft and Apple. But what's lovely is in the UK market, we're getting lots of small tech companies coming through. Unfortunately, they tend to get snapped up before they ever grow to being FTSE 100 companies. But there are actually lots of great tech companies, and plays on the digitization. The big innovation wave of our time, of course, is digitization and the internet. And there are lots of great companies in our market that are plays on that. So again, we own a number of those, like Future, for example, Future PLC. So lots of interesting themes that are exciting. There's lots of opportunities for growth, recovery and dividends in some of those more cyclical names. So yeah, I mean, there's lots of opportunities still.
Excellent. Now, I can't talk to UK equity manager without talking about Brexit. How are you managing the portfolios around this uncertainty that obviously Brexit is causing?
Yeah, so Brexit clearly creates that uncertainty, and it's been with us since the referendum a few years ago. And if we look now going forward about 8 or 9 weeks to the end of the year, really what we're now looking at is the difference between some kind of free trade agreement with the EU versus going to WTO terms or a no deal. And our sense is that in terms of what's priced in and where expectation sets are now, is that the difference between those now is not enormous economically. I mean, there are some differences, of course, but if you like, it's very difficult to forecast out a long way in terms of the impact of this. There's going to be big error terms in any modeling you've got. Probably, it's going to be front-end loaded. There will be a cost to no deal, of course, that will be front-end loaded into 2021. But if you look out more medium term, it's going to be more of a sentiment impact than an economic impact, actually, from here is our sense. And actually, our approach has been, now, don't get me wrong, there was a big difference between, not having a Brexit referendum where we were voting out and voting in, but that's not what we're looking at now. We know we're going out. It's just the terms we're going out on now. So that's the difference. Sterling is the big barometer, really, of Brexit, rather than the UK stock market, because of the reason I talked about earlier, which we've got the big overseas earnings constituent. So really, the sentiment tends to swing around in sterling. And so when people are a bit more optimistic about what the outcome of Brexit looks like, you tend to see a stronger sterling, and vice versa. So in terms of how we think about it in our portfolios, we took a view quite early on that this is probably an area we're not going to be expert enough to have an edge over the market. It's a very complex area. It's quite new. Sterling obviously was pricing, obviously devalued, and was pricing in a much more difficult outcome. And our view was, well, we're not sure. Yes, it's now at that sort of bottom. If you look at it on a real effective exchange rate basis, sterling's now right at the bottom. It's 50-year sort of trends. It's right at that bottom end. But it's a big call to say it's not going to fall out the bottom of that range, or indeed it could mean revert. So our view has been to hedge it, really. So within our portfolios thematically, what we haven't done is taken a big thematic bet on overseas earnings versus domestic earnings. We've tended to stay on that particular theme quite close to the benchmark. What we have done, though, is at a stock specific level, we've absolutely been talking to companies over the last few years about their preparations for Brexit. Are their supply chains safe and secure? And I think the encouraging thing is, versus when the referendum happened, and maybe when we had the first sort of potential coming out of Europe, when it was 18 months ago, I think if you talk to companies now, they're far better prepared now than they were then. So it looks to me like the supply chain disruption should be a lot less than maybe we feared 18 months to 2 years ago. Fingers crossed. So yeah, does that answer your question? We've got a reasonably balanced approach. It's not a theme. There are lots of themes running through our portfolios. I mentioned a couple earlier. But I would say Brexit isn't one. We're trying to not bet the bank on that one, if you like.
Yeah, no. I think realistically, it's the only way you can go. Like a lot of votes recently, it hasn't tended to go along the way that the path where certainly the majority of people think it's going to go, and that uncertainty is increasing all of the time. But as long as you've got a handle on it, I suppose that's the only thing that you can really ask.
Yeah, I think so. And I just think I think it's one of those things where actually the bigger impact that's going to, the bigger impacts on our I'm just getting a phone call. The bigger impact on our portfolios is going to be how the pandemic progresses and the economic recovery from that.
Absolutely.
It's going to be how central banks and governments deal with the fact we're at the zero lower bound of interest rates, and you've still got stalled productivity, you've got demographics, you've got price transparency with the internet and globalization. They're all having this downward pressure on interest rates, which is why bond yields are negative in Europe, and they can't get traction into the economy. There's stalled productivity. These in a way are much bigger issues at the moment for where you want to be invested in the stock market and how we're going to progress from here. So yes, Brexit's interesting, as is the US election, but I'd be more focused on some of those issues in terms of fiscal and monetary stimulus and how it's going to work going forward.
I completely agree. There's far too much stuff you can get concerned with that isn't going to actually impact that much on the portfolio. Dan, it's been an absolute pleasure. Thank you very much for your time. I'm sure we'll catch up again, but yeah, thanks very much.
Andrew, thanks for having me.
Cheers.